Welcome everyone to today's digital live event, CREtech Talks, European Proptech Venture Capital. My name is Ashkan Zandia, Chief Intelligence Officer here at CREtech and Global Head of Real Estate Tech Intelligence, and I'm excited to be your host today. In a few minutes, we will hear from three of the most insightful and active real estate investors as they discuss their perspectives on technology's impact on real estate and the impact of the pandemic on our industry. While we're waiting for everyone to log in into our today's digital live event and take their seats, I wanted to just quickly go over a few of our upcoming free events here at CREtech. On Tuesday, May 5th, we will be hosting our very popular virtual demo day where you will hear from the most impactful and most innovative real estate technology companies in the built world. On Thursday, May 7th, we will be hosting a webinar powered by OpenPath on the built world for the new normal part 5. And on Friday, May 8th, we will be hosting our CREtech Talk VC Perspectives Part 3, moderated by the prestigious Steve Weichel of MIT. And we have a long list of other real estate technology events also hosted, and you can find on CREtech.com, including additional CREtech Talks, virtual demo days in June, and another virtual demo day in September. I see that we have a large crowd gathering, so let's just kind of get the show on the road here already. It's my pleasure to introduce today's moderator, Emily Wright, Head of Special Projects and Tech Editor at Estates Gazette, Greg Depois, founder of AO Proptech, Faisal Bhatt, founder and CEO of Pi Labs, and Josh Mintz, Director of Waveline Ventures. Emily, welcome. The digital stage is yours.
Thank you so much. Just as you were doing the introductions there, somebody got a motorbike and drove it straight down the road in front of here, so perfect timing. So first up, thank you so much to everybody for joining us here today, and particularly for anybody in Europe. I hope that you've got a drink in your hand, and congratulations to, there goes the motorbike. Congratulations to everybody on getting through another week. It seems like Fridays are all the more celebratory these days, and what better way to celebrate and with this incredible panel. So it's so great to have everybody on, and from different regions as well, which is brilliant. So there was an introduction already, so I won't reintroduce everybody, but it would be great to sort of kick off before we get into the real detail. I just want to know how everyone's doing. How's everybody feeling? How's it going? This week has been, I don't know about you guys, it's been a bit of a tough one. We've sort of, you know, it's beginning to feel very samey. And I just wanted to check in and see how everybody is faring at the moment. So Faisal, let's start with you. How's it going?
Hey, I mean, we've all been in lockdown now for a couple of weeks, so getting used to it. It's strange. I think like you guys, I'm used to compartmentalizing my life. When I'm at work, I'm like 200%, you know, all about work and business. And when I'm at home, I try to be 200% about family. And I've got 3 kids at home, and now everything's kind of meshing into each other. So like I've had many business calls where my kids will be in the background and stuff. So it's really interesting just to bring it all together. We're making it fun. We've started new traditions like a family lunch that we do every day, which that was something we would only ever do on the weekends and stuff. So it's interesting, it's challenging, but we're making it work.
Brilliant, thank you. And where are you phoning in from or dialing in from today?
I'm in London, just out close to Richmond.
Brilliant, thank you very much. And Josh, how is it?
He's in his office.
Yeah, that's just so you don't see the heaps of laundry next to me.
Josh, how's it going? Where are you dialing in from today?
So I'm actually the partner of Waveline that's based in Tel Aviv, in Israel. We have a heavy focus on Israeli tech, so I'm here permanently. And we've been in a much more heavy lockdown for a lot longer than the UK. So I'm now on day 45 of haven't been further than the trash cans, except for one trip to the pharmacy to refill a prescription. And I got to tell you, I actually love it. I want to live my whole life like this. I'd love it to not have the specter of impending doom for thousands of people. But if we could let me work like this from home all the time, I'd be a happy guy. Like Faisal said, it's an interesting balance between family. As a split team between the UK and Israel, we're already used to working very digitally internally. So it hasn't been too much of a rough transition for us. And luckily, because again, a lot of the portfolio companies we work with are based in Israel, which is not the market that they're normally selling into. They're also used to working digitally. So in terms of workflow, not too much has changed, except like as Faisal said, family dropping in on calls. Like board meetings on Zoom have also become play dates for board members' kids. My kid will hear me talking to someone and run over to see that kid. But yeah, it's managing. Thrive. I wouldn't say we're thriving, but we're surviving, and that's what matters.
Surviving is good, and I love that minus the impending doom, you're loving it. So that's great. It's really good to have some positivity.
It's great.
It's good to have some positivity. And Greg, how's it going where you are?
I'm in London. Everything is great. Obviously, we're all in the same position. For me, it's been particularly special. I became a dad in the last 4 weeks, so life's completely changed anyway, with or without the virus. And like everyone else, we're adapting. I think for me, what's most important is to stay in touch and making sure that everyone, around me, whether they're people within my company or my portfolio companies, are doing well. And funnily enough, I think despite the distance, it feels like we've all come together and got closer. I think everyone, in the face of adversity and feeling a little bit vulnerable, I think it brings stronger relationship. And it's funny because we're actually not we're a distance, but we're getting closer. So I found that this was one of the positives of all of this, in my view.
Well, many congratulations on becoming a dad. That's very exciting. And good to hear some more positivity from you there as well. So it seems like everybody's moods are pretty good, which is great. But let's talk a bit about, the cold hard facts of things. And let's continue just for now anyway to focus on the short term. We're going to move on to the long term in a minute. But how do periods of uncertainty like this, which are unprecedented in recent history, impact on a sector or an area of the business like VC investment, and trends and startups and entrepreneurs, and how well equipped is that particular sector for this short, we hope, sharp shock? So Greg, let's start with you on that question.
Sure. I think you've used the right word. It's a shock. And I think everyone at the beginning has tried to make sense of what's happening. And I think every day that goes by, we're assessing and getting more data about, the progression of the virus, progression of the different government measures that are being put in place, and trying to understand how it's affecting us now. But I think what we find is we're, at least on our side, we're trying to understand what's happened after all of this. Once we reopen, is everything going to be the same, or how different is it going to be? And so, for me, the most important thing, and I've noticed this, whether it's people that are working in my company or my portfolio company, these are mostly young people that haven't been through a crisis. The last large crisis was 2008. So this is 12 years ago. So anybody who's been working for less than 12 years, has not necessarily been in the face of such a shock. So I think for me, what's been very important is making sure that I make myself available for all those people in our ecosystem to try to reassure them, to tell them, it's not the first time and it's not the last time you'll be going through a crisis. It might not be comparable, but to tell them it's okay. It's okay to feel stressed. It's okay to feel worried. It's okay to have bad days. We all have them. But eventually, the sun eventually comes out, and it's just, staying level-headed and just navigate the storm.
Thank you very much. And Faisal, what are your thoughts on that? How, as I say, we'll move on to talk about the long term in a bit, and really look at some detail on how the sector might recover from this. But in terms of that short, sharp, and I say short, and I hope it will be short, that short, sharp shock that everybody is feeling at the moment, both personally, but also in business. How does the VC world and real estate tech, how is it equipped to survive that?
So I'll look at this from the perspective of the startups themselves, the Proptech startups. And I think it's difficult to describe what's happening in the market with like a broad brushstroke, because really there are some nuances here. So just to give you a couple of examples, there have been businesses that have come into this recession having raised a large funding round. So they're pretty well positioned. They have a strong balance sheet. And although current transaction levels are probably suppressed, they're going to be able to withstand what's happening for the next 12, 18 months, if that's what the timelines are. Unfortunately, lots of other startups were not in that position, and they were going to market, and they might have been approaching close to the end of their runway and stuff. So there are businesses that are feeling this shock unevenly, right? That's the first point I'll make. I also think that business models matter right now. If you're a transactional business and transactions have halted and the market's frozen, you're very directly impacted by what's happening. But if you're, let's say, like a SaaS business that relies on subscription revenue, your income's not going to fall off a cliff. So it just goes back to my point around, it's hard to describe this with a broad brushstroke. There are some nuances to consider, and unfortunately, not all businesses will make it through to the other side, and we're trying to do everything we can to support our portfolio at this time, which is our number one priority.
And just a quick follow up to that, then, how are you supporting your portfolio at the moment? What's the strategy there?
A lot of people are asking like what companies should be doing at a time like this. Like the first thing we did was just take stock. We have 50 portfolio companies now, and there's a lot of them across Europe, and we needed to just take stock to see where the risks are, where the cash flow pressure is the most acute. And what we're having to prioritize is, we've recently just raised our third fund, and while we're open for business and making new investments, we absolutely have to prioritize looking after our existing investments and making sure we protect the businesses we've already invested in. So specifically, we're looking at who needs cash and how we can help provide that within the existing portfolio, in addition to looking at new investments.
Okay.
Cash is the most important thing right now.
Okay, thank you. Josh, and what are your thoughts on that, both on what Faisal's just said in terms of the strategy there at Pi Labs, and also on that broader point around, how well the sector is prepared for this shock to the system?
I'm actually extremely, I guess, not optimistic overall, because the reality is within this situation, everybody loses. The winners are still going to come out, even if they won on the micro. Like we have a portfolio company whose phone is ringing off the hook because some of their products are extremely COVID crisis friendly, but they're going to face the macro pressures out the other end that everyone's going to face anyway. So it's all well and good if the micro drives you some business right now, but those customers are hurting. That's why they're coming to you. They may not be there at the other side. So like everybody loses. We're all going to go out into a world where there's less GDP to go around, and that kind of sucks for everyone. So, the big high level macro is a challenging place to be. In terms of strategy, this is not this is something that venture-backed startups can handle. If there's one thing that I think defines for us, at the very least, what we think successful venture-backed startups look like, it's resilience, and it's the ability to overcome obstacles. I can't do that. I can't be a startup. That's why I'm an investor. I wish I could be a startup. I don't have what those guys have. Their ability to live in a world where they're constantly putting out fires and where they're constantly swimming against a current that is 1,000 times stronger than that most people could swim against. I think they're as well positioned as can be. If, as Faisal said, cash is king. We have to make the right strategy. We have to pull back. There will probably places you are spending money unnecessarily. We'll get in the trenches. We'll help you. We'll find you leads. We'll push it all forward. But ultimately, it's just the bar is a little bit higher right now. But the bar was so incredibly high to begin with for these guys. That's what makes our job a joy, right? Waking up and getting to work with the smartest, most determined people in an interesting space. So I'm cautiously optimistic.
Okay, and I think that this leads on to quite an interesting question around that famous phrase about opportunity stemming from adversity, which is a great, it's a great thing to hold on to in difficult times. But how real is that when you're looking at the cold hard cash? Because cash is, as Faisal said, it's the most important thing, and it's finite to a degree. And so how does that work? I think it'd be great to look at the situation and say, opportunity can arise from difficult times. I'm just wondering how realistic that is when you're looking at it from a financial perspective. Greg, you're up on my screen at the moment, so I'm going to ask you first.
Sure. I mean, I think one thing we need to also establish is that, potentially, unlike 2008, the sector is very well funded, in terms of funds. So there have been so many fund closing, in the last 6 months. Some of us on the panel, also closed. We closed in January at 250 million raise. So there is a lot of liquidity out there. So it's a very different story than what we've had before. I think what we find is that it's a tale of two worlds, in the sense that you're going to have, as Faisal said, the business are actually going to accelerate. Businesses which are offering product or services which, as a result of the crisis, are becoming must-haves. They might have been nice to have, there were interesting things to roll out in your portfolio as a landlord, but suddenly you're plunged into a new norm, and those products are becoming must-have. And those ones are going to be doing extremely well, and they're going to be attracting the capital. So, and you're going to have other businesses that potentially are not going to be staying, as relevant or as essential, in a world where maybe everyone is going to be more cost conscious on the customer side. And I think those ones are going to be struggling more. And the problem is the dry powder out there is going to be focusing on those winners. So you're going to have more less investable companies. So just the capital will be focusing on the few winners out of this. And I think that's going to make it even harder for the businesses that aren't necessarily, in tune with what's happening. So I think it's a tale of, obviously, as a business, to prepare to hope for the best and prepare for the worst, and try to see, at the same time, when you're trying to manage cost, is what can I do to evolve as a business? How can I iterate? How can I adapt myself to the new world? Whatever the world is going to be, we can only second guess at this stage, but I think we're starting to have a few leads as to how the near future might look like. And so, can I adjust my business? Can I adapt it? And I think it's a time where there are a lot of opportunities for the companies who are lucky enough that they have enough runway that they can continue to focus on grabbing opportunity. In those unfortunate times, a lot of people have lost their job, which means, there's going to be potentially talent available at a lesser cost. There's going to be, on the client side, your customers are going to be a little bit more vulnerable than they were 6 months ago, maybe more humble than they might have been 6 months ago. Maybe they're struggling as well. We have some companies, their biggest clients are the largest hotel companies, and they are very vulnerable now. So you can take this opportunity to strengthen relationship, extend contracts, and build relationship that eventually on the long term are going to pay off. So I think it's a very interesting time. I think all of us around here are optimistic. That's why we do the job we do, and we bet on the future and on the potential of people. So we like to believe in the great potential, and it's going to be really a tale of two worlds in my view.
Thank you very much. Faisal, similar question to you really. Opportunity from adversity, does it apply to this situation, and where are we going to see it?
I mean, I think that, we've been asked this question over the last couple of years about potential consolidation in the sector and M&A happening. And my answer has been, it's probably not time yet. And the market hasn't matured sufficiently. You don't have large enough players for them to merge together to really create value in an M&A situation. I've kind of changed my view on that recently since COVID-19. I think that this current crisis we find ourselves in might actually be a catalyst for underperforming or subscale startups to start to think about merging with competitors in their business that are better capitalized. And we're already starting to hear some early soundings around this. So while it may have taken longer for the consolidation to happen, I think this current crisis will act as a catalyst for that. So that's one observation I'll make. And then the second one is, and I think this echoes what Greg was saying, this is a time to really double down on your key strengths. So a lot of startups we know are really focusing on improving their product and building out their features because they understand that it's probably not worth knocking on lots of doors and really pushing hard on the sales front because the market isn't moving the way it used to, but you can reallocate resource to actually just coming out of this stronger with a stellar product And we're seeing a lot of people, a lot of startups kind of refocus their resources internally.
Thank you very much. So I'm going to move on in a minute and start off with you, Josh. Sort of talking about some sectors, potential sectors that look set to fare well out of the crisis. It's not the path to success I'm sure anybody would have wished for, but as we're talking about opportunity, it seems like a good time to look at that, and I'm sure people would be really interested to know. But a question has actually just come through on the chat that I did just want to ask. I don't know if you guys have seen it too. Is the market for seed funding really closed now in Europe? That's just sort of come up now, and rather than wait to the end, it seems like a sort of an interesting time to put that to you. Josh, what's your answer to that question?
It's a really difficult question to answer. I mean, the easy answer is to say no, the market is not closed. There are people who are going to be investing, and they will be investing at the seed level. What seed level means varies wildly from country to country, from firm to firm. I mean, seeds here in Israel, where we operate, can be, they're in the millions, not sub 2 million. In Britain, they're less. In France, they're different. In Germany, they're different. So I think if we talk generally more about like pre-revenue investing or early stage investing, I don't think the door is closed. I think everyone says that they're still operating. It's business, but it's not business as usual. And I believe them. I think we're in an environment where the bar is now higher than it would have been before, but the bar was already very high. Like I said before, I mean, we're talking about, from the deals that we've seen, we're investing at a 0.5% conversion rate. And we're not exactly in the biggest sector, are we? I mean, we're not in like, SaaS, right? SaaS software, business software. This is a broad thing that you can say, okay, I'll see tens of thousands of deals in a year as a firm. Like we're seeing hundreds of deals a year as a firm, and we're still coming out of it at low rates anyway. I'm not sure how material that will be. The only thing that I would say to anyone who's trying to raise early stage funds right now is to, really double down on your due diligence on the people that you're approaching, because you're going to spend a lot of time with investors that don't want to signal to the market that they're not willing to invest right now, or that they're very unwilling. They're not that they're not willing at all, but that the bar is unbelievably high and you're unlikely to meet it, but they want to stay hot, they want to stay relevant, they want to stay connected. So due diligencing the investors that you go to would be a very good idea. You can look at the portfolio. We have core things that we search for, and that relates to, who we think the winners will be out of this situation. And you can find content written by almost everybody, instead of just doing the big blast, you're going to come back and feel, okay, nobody's investing at the moment. But if you're more surgical, I think you can find partners. We've signed and transferred money since this crisis hit. Companies that our portfolio have received funds from other investors since this hit. I mean, it's not impossible. It's just hard.
Not impossible, just hard. And I think that's potentially the kind of the line that people are expecting, actually. But Greg, what are your thoughts on that? Is the market for seed funding closed in Europe?
So, yeah, it's not an easy one. I think we focus more on Series A onwards, but I think my general comment is a couple of things. I think number one, out of all of this, regardless of the sectors, I think the big winner is technology. Technology is the big winner of what's happening. And if you look at, if you take clues from some of the larger companies, from the public market and the stock market, you'll see that technology actually has not gone down, even though the stock market has suffered. And I think people realize that the way out of this and the way forward is going to be the adoption of technology across all the industries globally. And I think, of course, real estate is one of them, and probably more affected than those in the way that they need to integrate digitization to make operations, management, transaction possible in a new world where potentially you're not going to be able to be physically present as much, or a lot of the aspects of the market won't be possible. So is the market closed? I think people are cautious. If you are a fund today and you speak to your LPs, everyone, if you talk to them a few weeks ago, everyone is thinking, it's the end of the world. There's going to be blood in the street. Everything's going to go down 50%. And so when you're trying to invest, you might love a business, but you also have to consider what the market dynamics are, how liquidity is going to be there to support valuation over time. And so, it makes your job harder, because you might find an amazing business. And we are actually So we've continued to invest, obviously not at the same pace. We've closed a Series B a couple of weeks ago. We are in many processes, and it's not easy because you want to make sure that you can defend your investment regardless of what happens, and that it's going to be resilient, because it's going to be very easy for people to say, what else did you need to see out there not to invest? It's literally the world is shut down, everything is going down, millions of people, tens of millions of people unemployed. How are you still potentially paying those multiples, and why are you doing it? So I think I'm not saying that valuations are all going to come down, as I said. And I think a lot of people on the seed side, if you even look at people, angel investors, as a matter of fact, I think a lot of people who have been burnt in the stock market will reallocate money into places like venture, where they feel it's a safer bet for the future, as we all accelerate globally in terms of technology.
That's a very interesting point to end on, actually. Yeah, really interesting. Thank you very much. And Faisal, same question to you, and then I'm going to move on to ask about some of the technologies or the companies or the businesses that could potentially fare well in the current situation. But what are your thoughts on how investment and how seed funding is sort of going in Europe, and is it closed, or is it just cautiously sort of holding back? What are you noticing?
So the question is quite relevant for us because we invest pre-seed to A, so we are very much playing in this space. So it's not closed, it's changed though. So I'll highlight a couple of ways in which it has changed since the crisis started. Firstly, it's hard to value anything. So just like in property, RICS is saying, you can't rely on our valuations anymore. I think a similar thing's happening with venture, where you just don't know whether a seed valuation is the right valuation and whether that valuation will hold up after the crisis. So I think that the method of investing is changing. So you're seeing a lot more unpriced bridge rounds being done through a convertible loan note. So that was already happening pre-crisis, but I think that will happen more so as a lot of investors feel that it's more appropriate to not price the round. Right. I think secondly, to manage risk, you don't want to be investing in a round that's underfunded. So, we would feel nervous, and I'm sure other seed investors would feel nervous about investing in a company that has maybe just 9 months runway, because we just don't know how long the crisis will last. So we're getting a bit more conservative in our underwriting and looking for, larger seed rounds that can see the business through the next 12 to 18 months, so that they're ready then to raise the next round of capital. I think I think my main point is it's changing. We're open for business. We're still investing. We've taken a couple of deals through IC in the last few weeks, but it's just changing our approach to investing. But we continue to invest. We just are a bit more conservative in our underwriting.
Thank you very much.
Just to add to Faisal's point, I mean, just on our side, Series A onwards, we're also seeing much more convertible, and people are actually uncomfortable pricing. So I think you're seeing the same in terms of deal structure changing. So I'll echo that as well. Thank you very much. Let's have a chat before we sort of get some individual thoughts from you guys on what's happening within your own businesses, and advice that you would give to entrepreneurs and startups, because I think that'd be really, really useful and valuable, actually. Let's have a bit of a conversation about the companies, the startups, the businesses, the ideas even that look set to fare relatively well out of the current crisis. Now, as I said, it's not the route to success anybody would have wished for, but whenever there are difficult times, there will be companies and individuals who emerge, not victorious, that's the wrong word, but who emerge, who fared relatively well. So are there any sectors that you're noticing that look set to do particularly well? I mean, the obvious ones, I suppose, anyone who are working in hands-free technology, anything to do with, air filtration, all the stuff that people are now kind of coming back to fresh and more interested than ever before, given that it has been pulled into such sharp focus. So Josh, can we start with you?
Yeah, I'll take a slightly different and perhaps a bit less obvious direction. And if we expand like the world of Proptech a little bit outside of just the building itself. I think, yeah, you know, hands-free technology. I mean, you know, some of the world needs to catch up. Like it would be good to have contactless card payments here in Israel, so I don't have to keep touching things. That would be nice, but such is the way. But overall, a lot of those technologies are there and that money's been made, and big companies are going to make air filters at scale better and quicker than smaller companies. And, you know, startups trying to get into manufacturing is not always the smoothest way in an environment where capital is tight. So I'm trying to think and look at this as the places where software that's scalable without the enormous infrastructure cost is going to be able to make a huge difference. And I come back to construction. I come back to the actual building of buildings. Right now, we're in an environment, construction sits on a cycle. It's very much part of the built environment in Proptech, and it sits on a cycle economically that's a couple of years behind the general economic movement of a country. There's a lot of reasons for that. Mostly that it's a really slow process. So things that started a couple of years back are coming into play now. It also, residential construction goes up as GDP goes up, and then as the economy goes down, the government immediately stimulates by trying to create jobs through construction. You know, it's generally speaking low-hanging fruit, so you pump money into infrastructure. Like, this is a sector that's operating. It's been deemed essential almost everywhere. It sent shockwaves through the industry. When certain cities in the United States shut down construction, it hasn't been shut down. Even, essential construction has been continuing in the UK and Israel and Italy, the hardest hit places. And we're now looking at a sector that has been, unlike the landlording, ownership, and transactional sector of real estate, construction's been operating within this COVID environment for 6 weeks now in the Western world. And it knows what to do. Like the London office market just isn't seeing real transaction at the moment. Like it's tough to understand transactionally how the real estate market is going to respond to COVID-19. But we know that construction has to continue, and they've been doing it. They're looking for tools, some of which is, you can use COVID as a hook. If you're doing health and safety, and you can add in features that will make people more COVID compliant, then that's going to help you get your way through the door. But really anything that helps people support the construction site itself remotely, reducing the number of people that need to be physically there, is going to be beneficial. Anything that streamlines the process is scheduling, so you don't have people sitting around and being wasted. I mean, this is the industry that is going to continue through thick and thin. We are not going to stop building things. And that's something that for us is at the very least where we're keeping a close eye.
Great, thank you very much. Greg, same question to you.
Sure. I mean, I agree with what Josh just said. I think also construction has been the most inefficient within the most inefficient sector globally, and I think there's many ways that it can improve. And it's also the only segment of real estate where you start from a blank canvas with entering the new world, and you can start designing things to adapt to the new world. But I think he said it very well. I think on the rest of the market, I think anything that help digitize the experience. So think about all the tenant engagement that's going to be able to adapt to the new world. Anything that allows to manage and operate your assets, digitally from a distance, remotely, I think is going to be something that was needed already, before. And I think a lot of the large real estate incumbents were a bit behind, but I think now they don't have a choice. And then also they're going to have to be able to report to the investors much more frequently than they usually do. Typically, if you're a large real estate company or fund, every quarter you give a snapshot. Now people want to know, what was your rent collection last week? What was the default rate last week? What was happening? So you need to be on top of your operation really at the click of a button. So being able to digitize the entire process and the way you transact as well, removing human interactions of pretty much every process is going to be the places where people are going to focus. And I would say that you have a big challenge ahead where those large real estate companies haven't really, they've been plunged into this new reality. And so they're going to have to adapt very fast. And I think any technology or service that allows also to concretely save money and make operations more efficient, and you have an impact on the bottom line, I think they're going to be the one where money is going to be spent, because you're going to be able to, as a customer, show ROI on your investment and show, okay, I'm putting money into technology, but I have an immediate impact to my bottom line. And I think those technologies will be. Lastly, the last one I'll say is everything around climate change in real estate. I think remains a very hot topic, mainly also because there was, before the COVID, a lot of pressure from all the stakeholders, investors, customers, and now you have regulators also, that there are regulations in Europe that are in place and they're not going to go away. And so I think as we think of a cleaner, better world, this has been emphasized by COVID. I think all the initiatives around improving the carbon footprint of the real estate, and that applies also to construction. How we build, how we design, the materials we use, in incorporating biodiversity into buildings, I think are going to be themes that are very relevant.
Thank you very much. And Faisal, I just want to ask that question to you as well. Are you seeing any sort of trends emerging, any sectors that you think are going to fare comparably well?
So I'll just add some historical context to this. So like back in 2013, 14, when we started investing in Proptech, like there wasn't much going on, and the big corporates, who are the ones that are ultimately going to tip this sector over the edge, weren't paying attention. But in the last 18 to 24 months, I think all of us will agree that there's been a real impetus behind Proptech, with large global real estate companies starting to pay attention. And if you just take a look at the teams that have been set up, the heads of innovation, the heads of digital, they're starting to want to interface with the Proptech world. So we were right at the beginning of this massive adoption wave before COVID-19. And if you take a look at the systems being used pre-COVID within the large real estate groups, they're all the old legacy desktop-based systems. And all the Proptech guys have been coming up with cloud-based, mobile-first type, consumer-friendly, but B2B solutions. I'm talking specifically about B2B. I think what's going to happen post-crisis, because the workforce in real estate has gotten used to working remotely and using tools like Zoom, I think that we're going to see an acceleration of adoption now of these new cloud-based tools. And this wave that was already starting pre-COVID is now just going to be accelerated. So I recently commented in another article where this transformation in real estate may have taken 10 years. We think it's going to take now 2 or 3 years, right? So I'm not picking any specific technologies or application. I think this is a wholesale digitization and acceleration of the digitization of the real estate industry, and it'll just all happen faster now.
Thank you very much. I wanted to ask you guys as well what your thoughts are on Europe versus other regions. There's obviously some questions coming through, which we'll get to a bit later, from people sort of asking about, investment into US companies. But I'm interested to see from your perspectives how you think Europe specifically is faring at the moment. Greg, what are your thoughts on that?
Sure. You mean in terms of Proptech, Europe and Proptech, or you? Yeah. So I think that's a topic that's very dear to my heart, because I think there's always been this impression that Europe was lagging behind the US in terms of technology, and most of the people were saying obviously US is one block, Europe is very granular, so it's hard to adopt anything around consumers and so on. I think Proptech is a different story, and I think when we launched AO, we realized that there was obviously at this stage a gap in funding between the US, where you have some of the larger funds taking care of supporting companies post Series A. We were a bit behind in Europe, and I think we were doing pretty well on the earlier stages, and you had Faisal doing a great job in seed and up to Series A, and I think we were lagging a little bit that specialty. And I think Europe has a great opportunity. You have a very large real estate market. It's substantial. You have amazing talent coming out of universities, and so you have amazing engineers, and so there is everything you need to kind of to create the secret sauce. And I think one of the things we have in Europe is that we have regulations, whether there's GDPR, whether it's what's happening in climate tech with the RE 2020 regulations. And these are things that I think will help promote the sector, because our startups are learning and are building around regulations, which I think in the US they don't necessarily have, and I think it creates opportunities. And I think that real estate is the layer that helps wrap Europe in a more, let's say, homogeneous way, because you have, you know, similar landlords across different countries, similar tenants, similar problems, even though regulations or culture might be different. I think Europe has a huge chance to really become a leader in PropTech, given everything I've said. So I'm very hopeful for the future in Europe. And I think we've seen also some of the government initiatives around Europe before COVID. If you look at what France has been doing, and I think post-COVID, you can see that you know, the leadership in our countries is giving a lot of attention to what's happening. So I think that we have a great card to play.
Great, thank you so much. We've got about 5 minutes before we're going to sort of delve into some of our audience questions, and they're coming through thick and fast, which is brilliant. So we don't have time to kind of go to every panelist on every question now, but there is one more question that I'd like all of you to answer, which I'll ask now, and then we'll move on to some of the questions that we've been sent through. And that is, I'd love each of your perspectives, and I know that we've talked around this, but I'd love each of your perspectives on your advice to startups, entrepreneurs, anybody sort of, you know, with ambition still in this market, as to how they can move ahead, forge ahead in difficult times. And I think that, you know, we've touched on it in answers here and there, but it'd be really great to kind of each of you set it out in sort of a, you know, a sort of more formal way. Formal is a very formal word, but you know what I mean. Faisal, let's start with you.
So the first thing I'll say to the entrepreneurs out there that are looking to build a business is that just remember, just put this in context. Although this pandemic is unprecedented, historically, there's been a lot of great businesses that have come out of recessions, right? So if you look at the 2008 crisis, you had Zoopla come out of that here in the UK. In the US, you had Airbnb come out of that. So we still expect that out of this crisis will emerge great businesses. They already either exist already, or they're going to be formed out of this crisis. So for the entrepreneurs, I'd say press on and don't lose hope, right? There will be great businesses that come out of this. And secondly, I'd say while the fundraising environment is difficult, if you have existing investors, that should be your first port of call, because the VCs, all the ones that I've spoken to, are really prioritizing trying to help their existing portfolio companies get through this crisis. So go and speak to them, maintain that relationship, stay close to them, because they're thinking about you when they're talking about their portfolio reviews internally. And that's just a message I want to give to all the startups out there. The market is difficult to raise capital from new investors. It's open, but it's difficult. But your best port of call is to go back to your existings.
Thank you very much. Josh, the same question to you.
I'm going to split it into two, but I'll do each one really briefly. I think the pillar one is how to take advantage of the situation, as you said before, sort of turning it into an opportunity. And I think that I would counsel caution in this case. I think that the current pandemic and the fallout from it is a great place to add an additional in with the market, or an additional layer, or accelerate a process as things accelerate digitally. But don't try and build businesses predicated entirely on this, because people have short memories, and we will go back to something different. And it's hard to predict what it will be, and it isn't going to take as long as a lot of people think it is. And then the second thing would be how to deal with investors. And building on top of what I said before about really making sure that you're talking to the right people. As Faisal said, if you have existing investors, go back to them. There's no question about it. I mean, we're also, and I'm sure that everyone who is out there is doing exactly the same thing. You know, we're rethinking allocations, rethinking how many deals we're going to do, where are we going to do a holdback, how much is going to be held in reserve, and who's it going to go to. We're going to go harder in behind our winners than we were planning on, and we're going to do less new deals as a result of it. But I think the other thing is just to make sure that when you talk to investors, that you've had a lot of contact with the market during this situation, that you can create something that's feasible in terms of a projection, and more importantly, that the milestones, or that the proofs, or whatever it is, if you're a pre-revenue company, that like the product market fit proofs, whatever it is that you want to create, are ones which are attainable and achievable within this situation. And the stakeholders that you were talking to 3 months ago, they're not the stakeholders that you're going to be able to deal with now. The technology guys are too busy trying to get, you know, the 73-year-old white guy who is the head of everything to understand how Zoom works. And they're not really particularly well equipped to start dealing with onboarding interesting technologies. But there are people in charge of profit and loss accounts who are hurting, and they're interested in working with you, and they're interested in venting, talking through the process, have contact with the market, work to understand the market as well as possible within this, and make sure that whatever you're trying to project yourself as being able to do, like Faisal said, you know, you're going to be able to raise funds for 12 to 18 months to get through this. Make sure that you don't get to the end of those 12 to 18 months having missed all your milestones because you predicated them on an environment that doesn't exist at the moment.
Thank you very much. Now, I always have to balance up the moderating role with making sure we're hearing from all of our panelists and also sticking to the timings. So, Greg, I'm so sorry. We're out of time to come to you on that question, but you did have the Europe one, so it's kind of fair. And so we're going to have to go to, well, not have to, we are delighted to go to some of our audience questions now. So I'll hand back over for that portion. I have one final question, so if you could leave me 1 minute at the end, that would be great.
Absolutely, Emily. Thank you guys so much. And to our amazing audience and community, thank you for submitting your questions. If you still have a question you'd like to ask, please do so by clicking the Q&A button. Look at the bottom of your page. We asked the poll at the top of today's session. We will display those results at the end of today's webinar. So please click on the polling button. Look at the bottom of your page as well. So we have a lot of questions to get through. I mean, a lot of questions came through. And I'll start with the chat, the questions that came through the chat, but please submit your questions via the Q&A button. The first question that came early was regarding the market. And you touched upon the seed question, and we touched upon a lot of the questions throughout. But in terms of strategic software, you know, the panel has some amazing LPs, owner operators, managers, brokers. What kind of software are you guys seeing across the commercial real estate sector that's been pretty impactful throughout this crisis? That's a question for everybody, so please feel free to jump in.
I'll go fast if you want. Zoom.
Yeah. Go ahead, John.
Zoom's been a big one. They're a big winner out of this. I think across the sector is so broad that it's almost impossible to pin down like specific softwares or anything in that regard. But again, we're looking at anything that streamlines back offices. So if we talk about construction, then anything that streamlines the management of people without needing to physically be there with people. So communication interfaces, which kind of, you know, I said Zoom in a somewhat facetious manner, but I kind of mean it. Anything that allows people to communicate effectively without physically being near each other is having big uptake at the moment. Yeah, people are just more than they were before.
To pick up on that, you know, and talk about inefficiencies. So if we're going through a boom market prior to COVID-19, before C-19, we're definitely not in a boom market now. What's happening with dark spaces, right? Like, so we saw what Airbnb did, you know, during the 2007, 2008 crisis and moving forward. And so all those vacant units that came on market, and then Airbnb took them and made them short-term rentals in multifamily. What is your thoughts? And this is open to everyone. With everyone working from home, everyone now doing delivery to their homes, whether to their apartments or flats or to their homes in the suburbs. What is everyone's thoughts regarding ghost kitchens or dark kitchens? Where do we see that market?
Well, it was a very strong theme before COVID, and I think if anything, it's been just turbocharged. You know, as a result of the need for restaurants to access a certain network, the requirement of people obviously need to get delivered into their homes, and I think the third pillar is a lot of space are going to have to find new lives and new use. So I think it's a great backdrop for those companies, and there are some really good companies coming out of this that have, you know, that was pre-COVID again. So I don't think it's something. It's just more relevant than it was, but it was always on a uptrend in my view.
Basil, are you there?
Yeah, no, I'm here. So in terms of trends, I think there were strong trends before this crisis that will just become accelerated. So we all know the massive carbon footprint that our buildings and construction have. And now with the Paris Agreement and the 2030 and 2050 carbon neutral targets, companies have to comply here in Europe. And so there's going to be big investments that will continue to be made during this crisis and after this crisis on making buildings more efficient. There was a question that was raised earlier around mental health and wellness. And I think that more building owners will be starting to think about the wellness of their staff members in buildings, when we all go back to work. So we have a business based in Finland that we've invested in that tracks all kinds of things like
Oh, we got our first technical error.
Oh, Faisal, you cut
to
out.
our mental health.
Okay.
Yeah, sorry. So I was mentioning a company in Finland that measures all kinds of data points inside of buildings that can contribute to our mental health. So we think that trends like that, while they're in their early stages of evolution, will start to become more mainstream.
Awesome.
If I can just
go ahead,
point
Josh.
out, I've got a slightly controversial, I guess, but at the very least counter to what these guys are saying, concern here. I don't disagree, but I have a concern that this trend that we were looking at of more efficient buildings, greener space, caring about employee wellness, creating more efficiency in that regard, like we have a very real risk of reaching a severe enough economic contraction that we see like basically revenge pollution. If you look at kind of posters from the United States from the post-war era, clean air is communist, pollution means progress. And the relaxation of all of these regulations that so much of our sector is looking at as the building blocks and justification for the existence of the companies runs a risk of either being reversed or just not being adhered to. I mean, obviously the Nordics are different and Western Europe, but when we talk about industrialized Europe and then, when we talk about Asia and obviously other parts of the world, we have massive continents, we have the Americas, we have Africa, we have Asia. These are places that are very, very, very meaningful. And European Proptech companies are going to need to look to those places as well. Building entirely on the basis of that at the moment, I fear carries a very big risk because it might be one of the first casualties out of the other end of this will be those externalized costs that we've been interested in bringing down, but might not have the capacity to in a year's time.
So I'm going to quickly, thank you for that, Josh. I'm going to quickly just jump into the Q&A portion. People have been, wow, there's a lot of questions just in the Q&A feature itself. I'm going to take a question that came in at the top of the hour regarding the question, who's actually investing? Obviously, this amazing esteemed panel is investing, so we won't jump into that. But in terms of who's investing and what they're investing in, rather than kind of, you guys are obviously investing, but to help point that question a little bit, people are investing in the past 30 days. It's been actually, there's been a ton of investment. Over 2 billion has actually been invested in just real estate tech, not even construction tech, just real estate tech. And some of the investors if we just did it by AUM, we're looking at Fidelity, BlackRock, Wells Fargo, and T. Rowe Price. They've all invested the past 30 days in real estate tech. By number of investments, one or greater, Silver Lake, Sixth Street, and Apollo have all invested. And about 30% of the 2 billion plus has been invested in business productivity. So this whole notion, I'm a numbers guy. It's my job to follow basically the money. This whole notion that the real estate tech capital markets is frozen, I think is a little false. And I'd love to kind of get your opinion on that. Based purely on those numbers, we saw the numbers come through, that the registered numbers. What is our opinion of what's actually happening in the market? The assumption going into this is that investments are actually going to slow down, but we're seeing over $2 billion invested across 33 companies from 43 investors. What is our take on what's actually happening in the market?
There's so much capital out there, and I think, as I was saying before, there will be a lot of capital chasing fewer companies, and that's one of the things I've witnessed also is I've seen a huge pickup in activity from, let's say, the large PE firms, the 40, 50, 100 billion firms coming into a market that you necessarily expect to see them with smaller size tickets and smaller companies. because they are seeing the acceleration of some aspects of the market, and they also, a lot of them are thinking about using certain companies as a platform for aggregation of other peers in the market, and take advantage of potentially a market where valuation might be suppressed in some areas, to aggregate and to build a market leader. So I'm not so much worried about the availability of capital. It's more where I think there are fewer targets, and so it's going to make it difficult. It doesn't mean that because there is money it's easy to raise. I think that the bar has been raised, even though it was high. I don't think the bar was that high because there was a lot of money out there and a lot of companies. I think now people are going to be more cautious, but they still have to deploy this money. And so I'm personally not worried at this stage. Of course, I don't have a crystal ball. I don't know how the world looks in 6 to 9 months, and we might be in a very different position, but that capital is still there. It's been raised and it needs to be spent. So if you're I would just say for the startups out there, do your homework. Do your homework to understand, because everyone will take a call. Everyone would love to hear about your company. Everyone is curious. Everyone is sitting at home, and if they want to hear about stuff, that doesn't mean they invest. So do your homework. Understand who is actually writing the checks, so that you don't waste your time, and also so that you don't get desperate, or like depressed that you're trying and it's not working. I think do extra homework to understand who your investors are, and also understand your customers. They're going to be, in those large real estate corporates, they're going to be changed. People are going to get fired. The person you used to speak to is not going to be there anymore. So you need to understand what's happening within those customers of yours, so that you are not, let's say, wasting time or momentum because there's been kind of a musical chair and someone's gone, someone's been replaced. You have to really understand and make the extra work to understand those companies.
What I'd add to that, if that's okay, is that there's multiple pockets of capital out there. So if we take a look at who the major backers of real estate tech funds are right now, it's a lot of real estate corporates who are super interested in having their digital their fingertips on the pulse of innovation in the sector. They're also prioritizing ESG as a key strategic agenda item, and they see Proptech startups as a way through which they can meet some of their ESG objectives. So there are like motivations up the value chain in VC. If you take a look at the LPs that are coming into real estate tech. And then there are other pockets of capital as well at the seed stage. Angels in the UK still get EIS, SEIS relief. That's a motivation to be investing in the early stages. And there are family offices that we're in discussions with that are looking for, looking to get a more attractive valuation. So there are just multiple pockets of capital with different motivations. And you need to kind of study all of these different types of capital and see what's right for you.
I would just, on top of that, throw one thing specifically following from what Gregory said about doing your homework and doing your research. And like I touched upon it earlier, who's investing? People who are nearing the end of the life cycle of their fund. If you're talking about VCs that are on a general partnership structure, the people that you want to talk to first and foremost are the people who have more dry powder than they have time left to use it. Talking to people, of course, other people might still be investing and you can figure out one by one, but fund cycles is going to be important. Someone's raised, 50 million to 100 million euro seed fund within the last 12 months, then they're under not a lot of pressure. If someone's got a huge amount of capital under management, they can afford to take a risk with a chunk of it, and they'll be more likely to put some of it out there. And if someone is nearing the end of a 5 to 7 year fund cycle, and they've still got 20%, 30% of funds unallocated, and that's not including what they're holding back for follow-ons, then those guys are under a lot of pressure to justify their management fees. And they're the ones who are going to be seeking more actively. They'll squeeze you on valuations. It's not going to be the same deal as it was before, but a deal can be made.
Thanks, guys. Thanks, Josh. So I see a bunch of questions came through regarding convertible loans and C notes and transaction type business models. We touched upon that and just general market conditions and venture capital in Europe that came through. We won't dive into that. For anyone that wants to get answers to that, a recording of today's session will be live by next week, so you can we can touch upon that at a later date or just watch this video. But the question regarding co-living and co-working has come up often here. Obviously, it's a different type of venture. Some might say it's more propco than anything. Just generally speaking, obviously co-living and those business models have changed conventional real estate, but just what are your opinions on just co-living and co-working in general? And what do you guys think in the market?
I can comment on co-working,
Go ahead.
not co-living. So on co-working, I think that while there's an immediate headwind because there are no transactions happening and people are not going into offices, I do think that in the medium to long term, this transition in the office market between long leases and short leases is going to continue, right? Because the large corporates are not going to want to tie themselves into the 10-year leases. They want more and more flexibility in their portfolio. So we see that in the medium to long term, that trend will continue, but in the short term, there are headwinds and it's tough.
Yeah, and to add to that, I think on myself, I've always been wary of what we call the asset-heavy business models. I think co-working, you can also generalize. There is everyone thinks about co-working, they think about WeWork and all the things that went wrong with WeWork. But I think you have out there some smaller players who have a real sense of community, who are differentiated. It's not just about the desk, but it's about everything else that you offer. And I think those ones will be able to add different layers of their business, going to more digital, offering maybe digital communities or different things that people can access from everywhere, even they don't feel like going to the office. I think those guys will do okay. And I think they'll transition. It's about, as Faisal said, for me, it's about thinking about flexible office rather than the co-working idea. I think it's the community aspects of those players that will thrive. So for those who have that community, and there are a few players out there, I think they'll be able to adjust and iterate.
Awesome.
Yeah, I mean, I'd say that co-living is almost so nascent at this point that I don't feel remotely capable of qualifying, of commenting on it. But from a co-working perspective, yeah, I think you chunk it up. There are companies who operated on the premise that they would give a lot less square feet to each person working in that space than anyone else was. And those aren't going to be doing particularly well in the near future, I don't think. Crowding people into an office to make a better margin is not going to be the next couple of years. But there's definitely, I think there's going to be a meaningful shift, as Gregory pointed out, toward a different kind of co-working operator. I think particularly co-operating with the landlord as opposed to just taking master leases on large spaces and then subletting it. So landlords having to become more activist within the management of their own properties, which is great for technology companies because you have one less stakeholder in the way. So that's going to give us a better opportunity to help them digitize those processes and streamline those processes. And there's also going to be, as Faisal said, a movement towards shorter leases. We've already seen it. I mean, like our backers, and they're not getting the same bite from big public companies to take these long fixed leases on the spaces that they were. And they know it's going to have to be a little bit more flexible. We also have to be reasonable here. Like most of the people who are taking space in the world are not Google or Facebook, who constantly expand and contract their teams and build special projects and need ultimate flexibility within their space. Most companies that are taking space are taking mid-sized space, and they're pretty consistent with what they want for pretty long periods of time. They're just not going to want to commit to it in the same way. So we're going to see higher turnover rates, more competitiveness in the market. So anything that can help ease the transaction and ease the process of exchanging is going to be meaningful.
Yeah. So I want to kick it back over to Emily before disclosing displaying the results of today's poll. Emily, you had an additional question, correct?
Very, very quickly. I know that we are running out of time, but we've touched on it a bit, but I just wanted to ask about mental health, actually. I think that when you look at the startup world and entrepreneurs, it is a high risk game you're playing right from the word go. It's not for the faint hearted, and obviously the gains to be made are huge, but there's a lot of sacrifice that goes into that. So it's already a hugely pressurizing environment by default, and then you throw in what has happened to the wider world on top of that, and of course the whole world is suffering. But for that sort of specific market where you've got so much invested and often so much personally invested in a business or an idea, how can people sort of take care of that element of it? Because these are really tough times, you know, certainly for the short term. So I just wanted to know what the panelists' thoughts on that were, because I think it's important. You know, we're here to talk about investment in cash, but mental health is also really important too. So I don't know if anybody wants to jump in on that. If not, I will pick somebody.
Happy to jump in. We care a lot about mental health. That's a thing that's very important to me personally. So I think about it, you know, in our own firm and outside. And I think what we try to do is, I personally try to be very available. So all our founders and the people we've backed know that they can really always call me any time of the day for whatever. And I make a point to call them and actually explain that it's okay to be vulnerable. We also internally, we run, you know, open Zoom rooms where anybody from the company can just join, and I'll be around. We can talk about the blue sky or anything or bad things. And it's just trying to make people understand that we're all in this together, that there is, you know, it's okay that to be doubtful. It's okay to be stressed. But at the end of the day, I think, you know, being available and having empathy, I think go a very long way nowadays. And I agree with you. We talk about investing and money and all those things, but I think the sanity, all of our combined sanity, staying at home and having doubts, I think is something that needs to be talked about, and it's okay. And everyone should be able to come forward and express their sentiments and their feelings. So we try as much as we can to offer that platform for anybody that's part of our extended family.
Yeah, I mean, I'm not a psychologist or mental health professional, so I definitely can't give anything meaningful and insight for that. But like, yeah, be there for people is the same thing. You know, I was listening to a podcast with an interview with a VC, I won't say who, and he said that being there for your portfolio companies is not getting off your Peloton bike and then telling them they've got to fire people. Putting aside the fact that I was actually on my Peloton bike while I was listening to it, like unbelievable douchebag in that moment. I got off my Peloton bike and I didn't have that call. You know, making sure that space exists is great, but ultimately, you know, I can't put myself in those shoes. We're not in the same boat together. I've got aggregated risk. I've got a classic business model. I've got job security because I'm at an early stage in the cycle of my fund. Like I can contract the economic benefit of my future if I get it wrong, but we're not in the same space. And I don't know how to help those people. I can only try and be there for them and see if there's any small thing I can do, and at the very least encourage them to talk to someone who can help. You know, quite a lot of programs do. A lot of startup accelerators and programs will bring in performance coaches who are psychologists. You know, use them. Like, I'm not one, but someone else is.
Yeah, we have a little bit of experience with this. So I think startup life is super treacherous as it is, and it's a real emotional roller coaster, and we all know that. So I think the importance of community is paramount right now. So bringing all of your companies together with you, and just encouraging that sharing of experiences and talking to one another. So I think community is very important, and VCs have this inbuilt community because we have a portfolio of companies, and you can try to foster that communication amongst them. And the second thing we've just started to do, and this is early days for us, is actually involve experts. So we recognize we're not experts in mental health, so we're getting an expert involved with speaking to our companies and just being there with that for them and providing them that additional support over and above the community aspect that we're helping to build.
Just so you know, I'm getting a messages ping up. I'm already taking heat for admitting that I was on a Peloton bike.
I know mental health is a big issue that no one seems to talk about. And so, Emily, I'm very happy that you brought it up. I can honestly say that as an entrepreneur myself, and having launched several businesses, to anyone that's an entrepreneur, startup, or even entrepreneurs, the profession of entrepreneurship is a very lonely endeavor. So I think speaking to somebody during times of difficulty as well as times of success are extremely important. So whether you're find someone to talk to, male, female, boyfriend, girlfriend, husband, wife, the cat, the dog, it doesn't matter, a friend, talk to someone, just to kind of don't keep it bottled in, and because it can be very isolating and lonely at times. And for this is not a plug for any specific company, but I know a lot of friends that are in the entrepreneur world, that are in the startup world. They use an app called Talkspace. It's not a plug. I don't recommend them. I'm not saying anything about that, but they have mentioned to me that they do use an app-based therapist in order to kind of talk to someone. But to change notes on a more to end on a very positive, optimistic note, I want to share with everyone the results of today's poll. We ran a poll at the top of today's conversation on the most impactful technology in 2020, and the winner is, of course, with over 20%. It was actually very split, actually, but winning getting 20% of the votes, health and wellness tech was the winner, the most impactful technology in 2020. So Emily, you are right on the money there with your last question. So that's really awesome. Followed by tenant engagement technology at 16%, space utilization at 16%, virtual tours at 15%. I know virtual tours are getting a lot of love by the media these days. So that's a great win. So I know we're about 10 minutes over. I want to just quickly thank everybody for taking the time today. Greg, Faisal, Josh, Emily, thank you all for sharing your thought leadership today. I hope everyone, including our amazing audience and community, had a fantastic time, had a great time, because I certainly did. If anybody, if you have any questions about CREtech or about any panel ideas, anything that you want to kind of get out there, or just need someone to share ideas with, please feel free to contact us, from venture capital trends, how to even, if you'd like to set up your own webinar on our CREtech platform, if you'd like to promote your own product on the CREtech platform, or your own thought leadership on the CREtech platform, please do so. Please reach out at research@CREtech.com. Again, my name is Ashkan Zandia, and it was a pleasure to be your host today. Thank you to everyone that participated, including our amazing audience. Thank you guys very much.
Thank you. It was a pleasure.
Thanks for having
Greg,
us.
Faisal, Josh, Emily, thank you guys very much. Really appreciate it.
Thank
Take
you.
care.
Thanks. Take care. Have a good
Bye-bye.
weekend, everyone.
You too.
Bye.